I want you to imagine something for a second. You're walking down a street, let's say in Mayfair, right now, in 2026. You look in an estate agent's window, you see a flat.
Hmm.
And the price on it makes you do a double take. Because it's not today's price. It's the price you would have seen back in 2013.
Which, in a market like London's, should be impossible. That's practically a time machine. The arrow is always supposed to point up.
Exactly. And that time machine, that anomaly, is what we're getting into today. We are unpacking the London prime property market for 2026.
And our source for this is the latest index from Coutts, which was just reported by the WealthNet.
Right. And the big headline here isn't just about prices. It's about why experts are now saying this market is finally, quote, poised for renewed momentum.
It's a really interesting story. But before we get into the whole momentum thing, maybe we should quickly define what we mean by prime. We're not talking about your average home here.
Good point. No, this is the top end of the market,
Yeah.
the luxury sector. Think Kensington, Belgravia, those golden postcodes?
The places where global wealth tends to park itself.
Exactly. So if this sector is finally waking up, what put it to sleep in the first place?
Well, the market's been in this kind of paralysis for a while. If you look at the data from Coutts for the end of last year, 2025,
The fourth quarter, right?
that's the one. Growth was 0.1%.
So nothing. It's statistically irrelevant.
It's flat, completely flat. And that flatness has been the story for a while now, this prolonged wait-and-see behavior,
That's standoff.
a total standoff. Sellers didn't want to drop their prices, but buyers weren't willing to pay up in, a pretty stagnant economy.
Okay, but this is where I get a little skeptical. If it's been so dead flat for so long, why does Coutts suddenly think 2026 is the year it all changes? Is this just wishful thinking?
No, I don't think so. It actually comes back to that time machine you mentioned. That paralysis, it was masking a huge silent correction. Well, the nominal price, the number on the tag, didn't really move. But everything else did. We've had inflation. Currencies have moved all over the place. So when the report says prices in these hotspots are back to 2013 levels, that is a massive deal.
Let's break that down because 2013 levels sounds kind of nice and nostalgic, but from an investment point of view, isn't that just terrible?
Oh, for a seller, it's painful.
Yeah, if I bought in 2014, I've basically made zero return or even lost money over a decade.
In real terms, adjusted for inflation, it's a significant loss of value, absolutely. But if you're a buyer standing here today in 2026,
I see. It's a huge opportunity.
a massive opportunity. And that's the whole reason the forecast is shifted to momentum.
So you're saying the stagnation did the work of a market crash, just without the dramatic.
Exactly. Without the scary headlines.
Yeah.
There's a slow motion correction. The market has effectively hit a reset button on valuations, winding them back over a decade.
So when Coutts uses a term like long-term value, it's not just a buzzword.
No, not at all. They're saying that fundamentally, London prime property is trading at a historical discount compared to where it should be and compared to other assets.
So this renewed momentum they're predicting, it's not a new bubble. It's more like buyers are finally seeing that the bottom has been reached.
That's the theory. The wait-and-see crowd was waiting for a floor, and seeing valuations that have regressed all the way back to 2013 suggests we might have found it. It de-risks the whole thing.
It's just so interesting to frame a total lack of growth as a positive feature.
Well, in a high inflation world, finding a major asset that has effectively deflated this much it's pretty rare. It changes the entire risk profile. You're not buying at the peak of a hype cycle. You're buying what looks like a recovery.
So just to sum this up for everyone listening, the London luxury market was essentially in a coma through late 2025. But that inactivity meant real values dropped all the way back to where they were 13 years ago. And that discount is what's expected to finally get things moving again.
That's the narrative, yeah. The standoff ends because the price is finally right.
It's a powerful argument for a buyer, less so for anyone who's held property through all this. But it does leave me with this one big question.
Go on.
We always talk about prime real estate in cities like London as this, untouchable vault for wealth, the ultimate safe haven.
The safe as houses idea.
Right.
Yeah.
Exactly. But if that safe haven can just wipe out a decade of gains, are we seeing a fundamental shift in how urban wealth is stored? Or is this just a blip in London's centuries-long story?
It definitely challenges that mindset of guaranteed growth, doesn't it? If long-term value means you need a 13-year reset just to become attractive again, maybe the definition of a safe investment needs a bit of an update.
Something to think about for sure. Thanks for breaking this all down with us.